All right, with an understanding of diversification, the efficient frontier from Markowitz, we can now kind of, at least idealistically, derive the capital asset pricing model. Okay, so in this video, we're going to derive the capital asset pricing model. Let me do so by, let's assume that this is just some security market line here. And let's say there's a portfolio or an asset A right here, an asset B here, an asset C here, and an asset D down here. Okay, and let's say you're an investor and you have a choice between A and B. Which one would you prefer? Assume that this is the market line. This is what the market pays. So for instance, at this level of risk where B is at, the market only pays this much, whereas stock B pays this much. At this level of risk where asset A is, the market pays this much, and A only pays this much. Okay, so with that intuition, which stock would you prefer, A or B? Hopefully you see that anytime an asset or a portfolio, anytime an asset is above this security market line, you're going to want that asset over any asset that's below the security market line. That is, you're able to outperform the market on a risk-adjusted basis. Okay, so to derive the capital asset pricing model, let's think about this carefully. So if everybody saw this, so let's say everybody was given the choice between A and B, and then another choice between C and D. Okay, so let's say everybody sees what you see here, and they have to make choices. Then everybody would prefer to buy B and C, and they would prefer to sell A and D, or short sell it if they don't own it. Does that make sense? So think of what that would do. So if everybody demanded B and C, then the prices of stocks B and C would go up. And if the prices go up, then the expected return would go down, and these things, these assets here, would come and converge with the security market line. Does that make sense? So the excess demand created by the placement of these portfolios above the security market line is going to cause these things eventually to come down, because you're going to arbitrage away the risk-adjusted return premium associated with stocks B and C relative to stocks A and D. Okay? So likewise, the lack of demand, or let's assume that if you're short selling, then the supply of stocks available will increase for stock A and D. That will lower the price of stocks A and D and ultimately increase the expected return of A and D. Does that make sense? So over time, through the process of arbitrage, you'll have asset A on this line. You'll have asset B on this line. You'll have asset D on this line, as well as asset C. Does that make sense? So if markets are efficient, when I say that, I mean if markets can incorporate all relevant information concerning the risks of the company that they're trying to value, the market is trying to value, then eventually there will be convergence to this security market line, and nothing will be able to outperform the market on a risk-adjusted basis. So this is effectively the capital asset pricing model. The capital asset pricing model assumes that everyone will hold the market portfolio. And it's clear to see, I think, in the way that I try to demonstrate that, if any of these risk premiums or any of these price discounts are arbitraged away, right, then eventually every asset, so say there's another asset here, E, and another asset, F. Which would you prefer? Well, you'd prefer E over F. You would buy E. That would cause the price of E to go up, the expected return to go down. You would sell F. That would cause the price of F to go down, the expected return to go up. And eventually those two would converge to that market line. Does that make sense? So ultimately, the capital asset pricing model is assuming that everyone will hold the market portfolio. Now recall from an earlier video that if everyone were to hold the market portfolio, we can eliminate all of our risk, right? Just through the process of diversification. We can eliminate a large portion of our risk, and the risk that we can eliminate is called idiosyncratic risk, but we can't eliminate systematic risk. Sometimes we call this market risk. So if you hold the market portfolio, you're well diversified. You're diversified across every stock or every asset. However, you still can't get rid of all of your risk. You still face systematic risk. Does that make sense? And each asset has some exposure to that systematic risk. In a previous video, we compared Nordstrom's to Walmart, and we talked about recession risk. Certainly a recession is going to hurt both companies, but it's going to hurt Nordstrom much more than it's going to hurt Walmart, because Walmart obviously will sell more toilet paper than Nordstrom will sell cashmere sweaters. Does that make sense? So systematic risk is the only type of risk that matters when pricing a stock. The capital asset pricing model is as follows. The CAPM suggests that the expected return of any asset I is equal to the risk-free rate plus, I'm going to insert a symbol here called beta and explain what beta is, times beta times the expected return on the market minus the risk-free rate. That formula right there, I'm going to bold it. I'm going to, I'll increase the size of it. I need you to understand it. The capital asset pricing model gives us a theoretical justification for pricing risk in the expected returns of stocks. And the only risk that matters is this measure of beta. So let me tell you how beta measures systematic risk. So the guy that formulated the capital asset pricing model was named Bill Sharp. He won the Nobel Prize several years ago. Bill Sharp derived the CAPM, and showed that I don't know if it was luck or skill, but he showed that to measure systematic risk, all you have to do is take the ratio of the following. He showed that the ratio, so let me show you, beta is equal to the ratio of the covariance between the returns for asset I and the returns for the market divided by the variance of the returns for the market. Okay? Some of you that are really good at statistics know what that ratio is. That ratio is simply a regression slope coefficient from a regression of returns for stock I on returns for the market. And you get a slope coefficient that gives you the covariance of Ri to Rm over the variance of Rm. This is our measure of systematic risk. The market itself has a systematic risk, has a beta of 1. If I go up here, let's assume the slope of this guy is 1. Okay, the slope of this guy is 1, right? And there are other firms that will have less exposure to market-wide risk than the market itself, and there are other firms that will have much more exposure to market risk than the market itself. Okay, let me give you a couple of examples. Let's look here. Excuse me. I'm going to go to Yahoo Finance here real quick. I'm going to grab Walmart. And look, Yahoo Finance reports Walmart's beta of being 0.66, which is less than 1, which means Walmart is greater than or less than the market. Walmart's systematic risk, exposure to systematic risk, is less than the market's exposure to systematic risk. That makes sense. If there's a big recession or something extraordinary happens that's going to affect the whole market, Walmart will likely be affected less than the average firm in the market because people still need to buy toilet paper for a really cheap price. Cheap toilet paper for that matter. All right? And so there's Walmart's beta. Let me see if I can find Nordstrom. Of course, Nordstrom. Let me look at maybe Kohl's. Let me look at, I'm having a tough time here. Let me look at Macy's, the department store, not the, let me look at AMD. Oh, look at this. Perfect. Sorry, it took me a while. Here's AMD. They have a beta of 4.05. So AMD has a large exposure to market risk relative to the market, a large exposure to systematic risk relative to the market, while Walmart doesn't. Okay, so this will give you some inclination about what beta is measuring and about what the CAPM does. So we're going to use this formula here in the next few videos to simply calculate what we think the expected return for a stock should be given the CAPM formula, given the firm's exposure to systematic risk.